Good afternoon, ladies and gentlemen. Let's move on to the next session. We're going to talk about oil demand. Oil demand, the cyclical and structural changes that are taking place in oil demand at the moment. And it is, of course, a key focus in the industry because it's your so-called silent partner of your supply side. We're very honored to have Adam Sieminski with us to discuss how lower oil prices are impacting demand and the other factors that are at play. As you might know, Adam is a seasoned market analyst. Since 2012, the administrator of the Energy Information Administration. And the EIA is a tremendous source of information and data. It does, however, a lot of analysis, and that is why we have you here. The floor is yours. Adam, floor is yours.
Right. John, thank you very much for the kind invitation. I'm delighted to be here at the Oil and Money Conference. My two favorite things after my family. The idea here, I think, is going to be to go very quickly through a set of slides, and then I'll sit back down and we'll have a dialogue with you. So let's take a look at the cyclical and structural factors that are influencing demand. First one is we have looked at EIA at how our own forecasts have changed over time. So this is our preliminary forecast for 2014 and then our final forecast for 2014 for world oil demand growth. And we started out higher than we ended up in 2014. Same thing has been true so far in 2015. Interestingly, our 2016 numbers are now beginning to climb a little bit on the demand side. That little downtick that you see in the red line at the end here was the recent little, I'd call it nervousness about the economy in China. All right, so let's look at GDP forecasts. So this is non-OECD economic growth. Again, coming down from the preliminary 2014 forecast to what the final numbers were, a little bit below 4% GDP growth. The 2015 numbers coming down quite a bit. And 2016 numbers still edging down a little bit. So that's important because GDP is one of the main drivers of demand. Let's look at one of the other factors that has been very important, I think especially in the United States. And this is employment growth in the OECD countries of Europe, United States, and Japan. What you see here is a little pickup in employment growth from 2013 into 2014 for Japan and the EU, but for the United States, significant increases in employment numbers, which we believe have made a big difference in gasoline demand. Now let's take a look at some of the structural factors. And this is in the United States. The number of licensed drivers is rising, but so are the light-duty vehicle fuel economy standards. And vehicle miles traveled, although there's been a little bit of a pickup in 2015, have not been changing greatly. So the combination of all of this, I think, is putting some structural impediments in the way of gasoline demand in the United States. So here are the issues that we think make a big difference around the world. Adoption and increases in fuel efficiency standards. CAFE standards is, in the United States, is corporate average fuel economy, but this is the average fuel economy of the vehicles. European fuel tax and diesel-friendly policies, biofuel policies in the US and Brazil. In the US, it looks like we're kind of coming to the end of how much more ethanol is going in. There are still some efforts to change that policy around. Brazil, different story. One of the interesting questions, I think, will be, what about the impact of the Volkswagen diesel emission scandal on use of diesel engines in light automobiles, not trucks, automobiles, and it's very possible that that might actually lead to a little bit of an increase in demand for crude oil because it takes a little bit more crude to get gasoline miles than it does diesel miles. All right, how about developing countries' oil consumption trends? Brazil, Russia, India, China, numbers are still climbing. China, terribly important simply because of its huge size in these in the overall global economy. Let's look more specifically at the growth in liquids consumption from these four major countries in the transportation sector. So Brazil, Russia, China, very small in a sense relative to China, but look at China's transportation use and industrial use. Now the transportation numbers and industrial numbers in China are going to be very clearly related to GDP, probably more related to GDP than price. Let's look at what kinds of fuels were being used in these countries. On the left-hand side, what you see is diesel fuel consumption. On the right-hand side, gasoline consumption. So an interesting pattern emerging there where diesel consumption, even in the non-OECD countries, looks like it's beginning to level off, but gasoline consumption rising. That might suggest, again, that some higher demand growth is possibly coming. How long, to what extent would a prolonged period of low oil prices impact this situation? This is now just for the United States. It shows gasoline demand, that's the red line, the blue bars, products supplied, and gasoline retail sales prices on the red line. There's clearly a relationship with higher gasoline prices being reflected in lower consumption. Some of that, of course, was economic issues, but it's pretty clear in the United States that $1 per gallon less gasoline is encouraging people to go out and drive. Now, a lot of economic work has been done that says that it's the change in prices that really makes a difference, not the absolute level of prices. So the biggest change was from last year to this year, and as we go out into 2016, unless oil prices fall further, what we might see is that price impact beginning to shift and go the other way. Macro impacts, hugely important in the non-OECD countries, and this shows non-OECD GDP growth, that's the line, and consumption growth, the bars, kind of following each other, so somewhat lower estimates for GDP growth being turned into lower estimates of liquids consumption. Well, I'm getting very close to the end of these slides, and I promised I would do this quickly. I'm watching this gigantic clock, which you don't see from your seats, but I can see with numbers about this high that tell me to move on. The prices and economic growth clearly are very important, but policy preferences and technology ultimately could actually have a bigger, longer-term impact. What types of consumption and pricing policies are going to be enacted around the world? What about fuel subsidies? What about environmental policies? What about domestic security policies? What do the trends in light-duty vehicle use really look like? Ownership rates picking up in the non-OECD countries, efficiency and emission standards being very important in many countries to try to limit oil consumption. Technology and alternative fuels. One thing that I think is true with the drop in oil prices, the shift of natural gas into the transportation area, natural gas vehicles, whether compressed gas or LNG, other methodologies, probably is being limited by the fact that gasoline and diesel fuel look very attractive economically now relative to some of the alternatives. That's probably true of electricity as well. Where are goods going to be produced and how will they be moved? One of the things that we're finding in the US is we're expecting that that diesel fuel consumption will continue to grow very strongly in the U.S., not in light-duty vehicles, but in the heavy-duty trucks. As the population in the U.S. grows, as the economy continues to grow, a lot of goods are going to be moving around the U.S. in diesel trucks, and I think that that's generally true around the world. What about industrial sector efficiency improvements? Some of the opportunities to save electricity and the use of oil to generate electricity outside of the OECD countries looks pretty good. There are some new electric motors that could use electricity much more efficiently than the current landscape. So when I was asked to talk here, people wanted me to finish up with some thoughts on what the landscape of oil trading looked like given the shifts that are taking place among financial institutions. Been a lot of sales among financial institutions getting out of the commodities business after the legislative changes in the U.S., including things like my own former firm, Deutsche Bank, Barclays, UBS, and others eliminating their commodities businesses over the past few years. Interestingly, despite that shift towards other institutions in oil trading, volumes for both Brent and futures contracts have actually moved up since 2014, and the open interest in WTI and Brent are higher now than they have been in the past. And to me, one of the remarkable developments that you see on this chart is that trading volumes in open interest, rather, is now greater in the Brent contract than it is in WTI. I suspect that that's something that's going to last for a while. So, John, I'm going to sit down now. That's the advertising page. Please come to the EIA website. It's all free. We don't charge like some other institutions. And we'd be delighted to try to help you out with whatever data and analysis questions you have. Thank you very much.
Thank you, Adam. To pick up on your GDP and demand growth aspect, it used to be that the OECD had basically a zero demand growth or even a little negative. Now we're up. OECD is a quite important driver of oil demand growth. What's different this time?
Yeah, I think that basically along the lines of what I indicated, the U.S. numbers have really helped lift the overall figures. And I think that that's a combination of the improvements in employment, the decrements in unemployment, the lower oil price, and whether all of that can continue into 2016 and 2017, I think, is an open question. In EIA's medium and longer term forecasts, the non-OECD countries are still extremely important in terms of where demand is going to be coming from.
Even Europe was up this year. What do you make of that?
Well, when oil goes from over $100 to $50, people want to use more of it. I mean, that's kind of a basic law of economics. And if the earlier panels are right, we have a greater likelihood of $75 oil ahead of us than $25 oil. And that is going to take away some of that price support that we've seen for demand.
Yeah. U.S. oil demand has increased in part because of lower prices. Do we see that price feeding into demand in other regions?
Well, clearly we're seeing demand picking up. But again, in our analysis of this, the most important driver is probably the combination of policy and economic growth and not the price change. Price change makes a difference in that first year or two when the price drops, but then that impact begins to soften while the others kind of continue moving down the valley like a giant glacier, scraping away the sides of the valleys.
One of your slides shows this wonderful red line for 2016, oil demand going up. Is that what you think we can sustain?
Oh yeah, I mean, I don't think that there's anybody that believes that global oil demand is not going to go up in 2016. We were revising our numbers up because we did see strength in 2014 and 15 that add to the numbers. So some of that is a correction of the base numbers. Some of that is allowing a little bit more growth. We have global demand, this year growing by about 1.2 million barrels a day, and you've heard that number from others as well. So one of the things that I think that you should keep in mind, look, if you're very pessimistic about demand, global oil demand, it grows by 1 million barrels a day. If you're very optimistic, it grows by 1.5 million barrels a day. So you have 500,000 barrels a day play in that number. The key, which is not the topic of my presentation, but I hope somebody asks me about, is what's happening on the supply side. Because the supply numbers are changing dramatically more than the demand numbers are changing.
What is happening on the supply side?
If the global balances are going to come back into balance.
What is happening?
Well, what is happening?
We heard Mark,
Thank you for that.
We heard Mark Papa say earlier.
Well, in the United
States, leveling out,
right.
And then we're going down 600,000 barrels a day.
In the U.S., we had crude oil production up by a little more than 1.2 million barrels a day in 2014, another almost 400,000 barrels a day of condensate, natural gas liquids growth. So the combination of natural gas liquids and crude oil and condensate had put the U.S. alone at growth of more than 1.5 million barrels a day. For crude oil in 2016, EIA is forecasting a decline of about 4%. That's about 350,000 barrels a day. So it's not as much as the 700,000 that Mark Papa talked about earlier today, but it is a decline. We are looking at crude oil production in the U.S. in 3 different ways, 3 different methodologies now. The latest one is a direct operator survey of the key operators in 15 states, the Gulf of Mexico, and Alaska. And what that's showing is crude oil production in the United States is coming down. Now, not sharply, but it is coming down. Now, if you say, well, the rig count has collapsed, why isn't it falling further? A lot of improvements in technology and cost cutting. You're using the best crews and the best rigs on your best properties with the best technology that you can buy, and you're keeping production up. Whether that can continue into 2016 with the cuts in capital spending and operating tightness that's going to be apparent is going to be interesting. So coming back to these production numbers, what we are finding in this direct operator survey that we're doing now is that production is definitely coming down in places like Texas, North Dakota, and elsewhere in the United States.
Yeah. Before I open it up, one follow-up on your remark about diesel and diesel demand. You kind of joked and said it gives an opening to more gasoline demand.
That's not a joke.
So you imply that diesel demand will be affected.
Right. Yes, absolutely. Basically,
in Europe,
diesel fuel has higher fuel economy on average than gasoline in most vehicles. There's certainly more progress that can be made technologically in gasoline engines, but if we see in countries like China, Brazil, India, and Russia a move towards gasoline, if we see in Europe a move towards gasoline, and if we see in the United States a curtailment of the nascent growth that was occurring in some light duty vehicles, the net result, I think, would be somewhat lower fuel economy, which means more demand for crude oil to satisfy the transportation needs. So no, I might have smiled a little, but it's not a joke. It's a pretty serious issue.
Thank you. We have questions from the floor. Can we have a mic in the front, please?
Thank you. My name is David Howe. I'm chair of the Windsor Energy Group, president of the Energy Industries Council, and former Secretary of State. I wonder if we've focused closely enough on what is being said and planned in Beijing. I mean, the scene you've described on the production side is a lot more oil. There's going to be massive amounts more oil. Whether it's glut or short of glut, I don't show. On the demand side, the Greens are eating in at the edges to world demand for oil, all fossil fuels. Out of Beijing is coming the message, look, we're not going to be, first of all, an industrialization. We're not going through the Dickensian phase that the West went through. And secondly, on energy side, we're not going to go through the gas-guzzling, high consumption phase that the West has gone through. We're just going to cut that out. We're going to move to new technologies. And just as Europe and America have registered almost flat oil demand, in fact lower oil demand until very recently with this little uptick you described, the Chinese leaders are saying that's the way we're going as well. That's our normal. Mm-hmm. And if that is so, it seems to me a lot of your thesis, which is relying very much on non-OECD oil growth, begins to look rather weak. I wonder what you think.
I certainly think that countries like China and India are going to be terribly important in the energy future. One of the things that I think that they'll have to give very serious consideration to is how to control emissions from coal burning, for example. As far as oil is concerned, it's still, I think, almost amazingly around the world for basic transportation needs, most easily met by gasoline and diesel fuel consumption, and that central planners can have views that are often ignored by the people who buy cars.
Thank you. A question in the front.
David Knapp, Energy Intelligence Group. Thank you, Adam. I'm actually going to ask about demand. We heard a word this morning that we're both familiar with called elasticity, and the importance of that word. Elasticities are not uniform across either time or regions, right. And I'm wondering what you can tell us about the differentials between the elasticities in developed countries like the US and Europe versus what's going on in China, and let's not forget India as well. And in deference to Lord Howell, which I agree with, I'm calling China the Saudi Arabia of the demand side because it's important. And so I'd be looking for that. The other difference is, of course, that there's an asymmetry in demand responses to increasing price versus decreasing price. And for gasoline, it's particularly important because one affects your choice of the energy using capital, i.e. your car, and the other affects how much you use it, the vehicle miles traveled. So if you could comment on those and how they figure in your forecast. Thank you very much.
Sure. Let me just be brief in that, since I think you actually covered it quite nicely. And I didn't realize that my answer was going to be so stunning as to knock you out of your chair, and I can only hope that more people will have the same reaction. So, I mean, one thing, Dave, that I think every economist that's looked at elasticity, there's more than one kind. There's the price elasticity of demand, and there's the income elasticity of demand. And I think that what I said during my presentation is that the income elasticities of demand ultimately win in the push on the demand side. The prices go up and prices go down, and ultimately there's a body of language out there that says that prices revert. GDP doesn't. I mean, we do have slowdowns, we have recessions, we have declines in GDP, but if you look at GDP over time, with population and improvements and labor productivity and so on, GDP goes up. So, and in fact, that comes back to Lord Howell's question, is that if GDP is going to grow in countries like India and China, that's going to need energy, and where that energy is going to come from is going to be very important. And so we come back to the price elasticity questions. I think what we're trying to say is a combination of GDP growth and the kinds of policies that do get set in place on things like fuel efficiency, maybe shifts towards electric vehicles and so on, but where's that electricity going to come from in China? Just as an example, I was over there a month ago, and the Chinese policymakers and some of the reporters that I met were saying that the growth estimates for Chinese nuclear might be too high given some of the reactions that we're seeing in the China voting public in reaction to Fukushima. That coal consumption is coming under constraints because of the air quality issues in China. That leaves you with natural gas and the tremendous effort the Chinese have made on things like solar and wind technology, which I think will grow. In EIA's numbers, renewables grows faster than any other form of energy supply over the course of the next 15 or 20 years. But fossil fuels still remain a hugely important part of the entire energy distribution chain, even in the years 2035 and 2040.
Question in the back. Yeah, middle.
There we go.
That's me. Morten Saxi from Statoil. Thank you very much for a very interesting presentation. But we are talking here about the balance between crude oil production and product demand.
Right.
Yeah, but there are really two balances, right? There's one between crude oil production and refinery intake, and another balance between refinery output and products demand.
Mm-hmm.
And the only place where there is capacity constraints at the moment is between refinery gasoline production and demand for gasoline. How do you see that one developing?
And are you speaking specifically about America, the United States, or?
America's case in point, because when you look at your monthly stats, and for July we had demand growth of some 200,000 barrels per day, 350 in June, but gasoline production did not rise. It was at capacity.
Right. So one of the interesting questions about the growth that we've seen in gasoline demand in the States is the numbers that you're looking at are the summertime. That's when gasoline seasonally goes up. We'll be very interested in seeing whether or not in September, October, November, and December, whether we still see the same pattern. Back to the question of refinery capacity, out to the year 2020, maybe even a little bit further, we see another 1 million barrels a day of refining capacity coming on in the U.S. We looked at this as part of our crude oil export study. Let me just give you a couple of conclusions from the crude oil export study. The first one that all of the policymakers want to know is if the U.S. relaxes the rules on crude oil exports, what will it do to gasoline prices in the United States? And what EIA has said, based on the historical evidence, is that if anything, gasoline prices will go down if you allow crude oil exports from America rather than go up. And that's because our gasoline prices are already tied to the global market, to Brent crude oil prices, and having WTI or mid-continent oil prices go up really won't have much of an impact at all on gasoline prices. The second thing that we found was that in our current reference case, with lower oil prices and a slowdown in domestic production, the U.S. refining system is probably capable now of handling a lot of the light sweet crude oil that's being produced. There have been a little bit of that cork has been pulled off of the bottle top, and that is 500,000 barrels a day of oil is going to Canada. 100,000 barrels a day of lightly processed condensates can now be exported. And the latest thing that the Commerce Department has said is that they'll allow a swap with Mexico so that some of the light crudes from Eagle Ford will go to Mexico in return for heavy crudes coming back. I think that the bottlenecks in the refining system will be limited. Now, if we get back to $75 oil, and if U.S. production, with the technology improvements, begins to climb again, that wouldn't be the case. And what we said, in a high resource, high production case, you would actually start to shut in some of U.S. crude oil production, and that would lead to much bigger spreads between Brent and WTI than what we've seen recently.
Apologies to the hands I saw out there. We're out of time. I want to thank Adam.
John, thank you very much.
We have a lot of policies in this mix. The brew results in higher demand. That's the outcome. Thank you very much.
Thank
Adam
you,
Sieminski,
everybody.
please join me in thanking.